Lauren, I'm going to begin with you. I just want to get your take on the rally, especially with your take that you think that investors, they should avoid industrials and some other cyclicals. Now we've seen industrials actually take leadership in the market year to date.
Well, look, the news that we got over the weekend with respect to tariffs is really helpful for the U.S. and global economies. It removes one of the worst case scenarios for trade developments. But these pieces of news are not finalized yet, and so we see a challenging environment for equity markets ahead. There are a couple of components of this. The first is that tariffs, though lower in estimate than they have been recently, are still at century-level highs. That's challenging for U.S. businesses. It's challenging for the global economy. And second, with tariffs being much higher, but not at embargo levels as they were just a few days ago, that creates a dynamic where companies are now going to have to be really grappling with whether they pass higher costs onto consumers or take that hit in margins. And our best guess is that it'll be a combination of both, which creates a challenging environment for equity valuations ahead. And so while we don't necessarily dislike industrials, we favor equity sectors that are more a function of the global megatrends that are being backed by these developments, including materials, energy, a little bit of industrials, backing into the infrastructure that the administration is looking to build, as we see that these may be more resilient regardless of which direction the equity market moves.
Seema, coming over to you. Yesterday, we saw the dollar pop. Obviously, we saw stocks move a lot higher. Do you believe yesterday and this pause when it comes to tariffs or the temporary tariff reduction, does that end the questions about American exceptionalism? Does it end the worries about the Sell America trade?
Hi, Frank. Well, I think there are still going to be questions being raised. I mean, Lauren made some really good points there. Tariffs are still quite high. Businesses have got to navigate all of the various cross currents that they're going to be facing. But we do have a slightly more positive outlook in that this is, of course, better than we were just a week ago. So we are also upgrading our growth forecast, pushing out Fed cuts. So as a result, the U.S. exceptionalism argument is still in play. But I think the important thing is in the last month and a half, what the Trump administration has done with tariffs is really galvanized a lot of action from other countries to try and secure their economic foundation. So, for example, with Europe deciding to increase their defense spending, for Germany, really importantly, deciding to increase infrastructure spending. And increasingly, we're hearing discussions around thinking about deregulation. So I think growth forecasts for future years are slowly being upgraded. So that means for investors, you have more of a choice when you're thinking about where to invest. Global diversification, I think, has become more important, more pertinent than it was before.
So, Lauren, coming back over to you. We talked about Goldman reducing its odds of a recession. Also looking at the VIX. The VIX now back below 20. Do you believe that the quote-unquote risk-on rally, is that just going to be going on from this point on? And if so, what sectors do you see being the biggest beneficiaries?
I don't believe that we'll have a risk-on rally just go from here, but I do expect that we have moments of very constructive news coming forward. We have a tax bill that's underway in U.S. Congress. We have deregulation that's only just begun with the U.S. administration. Essentially, the elements of policy that were a part of the animal spirits and U.S. exceptionalism narrative that dominated the beginning part of the year, those are still to come. But the impacts and sort of worst felt realities of the tariffs are still to come as well. And so really what we're looking at is a market that is two-way volatile. We expect inflation, rates, and valuations each to be volatile. And so a couple of things that we're doing to navigate that type of volatility. The first is to acknowledge the reality of geographic diversification. I think that Seema's right on with that perspective. And we're seeing not necessarily a fire sale, in fact, far from it, of U.S. assets, but a consideration of where are our most value-add potential assets and in the U.S. and also balancing out some previous underweights in places like Europe and Asia. The second thing that we're doing is thinking about asset class diversification. If we expect equity markets in the public markets to be more volatile, can we take some equity-like risk in credit or in the private markets, especially in the lower middle market where we see more sources of value creation? These are areas of potential income generation and ballast that investors can leverage in order to create that more balanced profile.
You know, Lauren, you mentioned inflation. Of course, we have the CPI coming up later today. I'm looking at the numbers right now. Core CPI expected to be 2.8%. What does that mean for the markets?
doesn't mean a whole lot today, other than that I do think that a number that benign, which is around what we expect as well, is good news. It's sort of no news in a previously disinflationary environment. Headline inflation likely to be weighed down by seasonals here. Goods prices were largely disinflating, and we expect the inventory we've built up that we've seen in April to be constructive here. But again, as we look forward, as trade policy takes this potentially more manageable position, there's a real challenge that companies face of whether they will pass higher prices on to consumers or take a hit at margins. And we do anticipate that it will be a little bit of both. But if we see inflationary figures around this level for the rest of the year, even, which let's call that a good, even best case scenario, we expect, in fact, a bit more of a reacceleration. That's a profile in which the Fed can do very little. In fact, our base case perspective is that the Fed will do as much as it can to do as little as possible, given this uncertainty profile of the U.S. economic backdrop. And so that, again, creates a relatively challenging perspective for upside potential with equity valuations.
Seema, I'm going to give you the last word. Are there market ramifications when it comes to this CPI report? I'm looking at with the CME Fed Watch. The odds of a rate cut in July, they've gone from 57% a month ago, now down to 37% after the trade deal. Does the CPI, does it have market ramifications in your mind today?
No, I think the market is moving past it. I mean, we're not anticipating any impact from tariffs to really show through till the end of Q2. So ultimately, today's print is old news. Of course, if we do see signs of any supply chain concerns feeding through to prices, the markets may react. But ultimately, with the news that we've heard yesterday, the expected impact on inflation over the whole year is going to be that much less. So even if there is an inflation impact, it's likely to be subdued, it's likely to be quite temporary as well. And to Lauren's point, from the Fed's perspective, this does reduce some of their concerns and pushes out the date for the next rate cut, most likely.